All right, in the next 20 minutes, we're going to negotiate a term sheet. And Shalendra from Clipboard is either going to successfully raise a round that's going to set him off to the races, or he's going to sell himself into indentured servitude, work like a dog for 5 or 7 years, and end up just making a little money for his investors. And you guys are going to play a role in the outcome here. Okay? I need your help on both sides of the table. So first I'll introduce our combatants, our guests. Shalendra introduced himself earlier, but he's with Clipboard. He works with Gary in a number of capacities, and he has a lot of exposure to the venture world, obviously, and the startup world being in it currently. And then a lot of you know Joe. Joe is going to be an investor today, but in his real life, he's actually one of the most well-known and successful startup lawyers around town. So he's got a pretty good idea of both sides of the table, but he's on the investor's side today. And unfortunately, we didn't have the cool intro music. Sorry about that. But just imagine. All right. This is a seed round. We're not raising $10 million from Tom and Cam. We're going to raise a little bit of money, enough to get off to the races. These are the deals that we see around town. I've been involved in 5 or 6 of them in the last year. The term sheets tend to be negotiated. You usually have an angel who takes the lead and negotiates and then builds comfort, and then the other angels follow. That's the role that Joe's playing. And we have the entrepreneurs who are passionate about their idea but want the deal to be fair. The first question is going to be valuation. This will be a short discussion because we're not going to throw up a bunch of data on valuation. It's a bit of a throw of the darts. But Joe, let's start off with you.
Hi, nice to see you.
Hi, thanks.
Thanks for taking the time.
Of course.
Hey, so we've prepared a term sheet here we'd like to talk about with you, and sent to you by email, so I think you have it. But first off, we're thinking we'd invest $1 million. We'd invest it on a $3 million pre-money. So after the deal, we'd have a 25% ownership stake in your company. We calculate the price per share on a fully diluted basis, taking into account your option plan, which I think is about 15%. And so as a fundamental matter, that's sort of where we're starting on that issue, on the valuation question. So I don't know if you want to start talking about that now, or if you want to study the whole term sheet or dive into other areas, but maybe we want to start there.
Yeah, I think we should definitely talk about valuation. I think so. The idea is great. This is a growing market, as some of the other VCs were saying, that timing is everything, and we have gotten some of the great customer validation already. And our advisors have been advising that our pre-money valuation at this stage is like $8 million. So I think $3 million is a non-starter and a deal breaker.
All right. Non-starter and a deal breaker. Oh, right out of the gate. Yeah. Take the game to the lawyer.
I'm sorry. Well, we really like you guys. That's why we're here today. So I think we got to make it work. But that's non.
Okay. Well, listen. I'm just your average angel investor in Seattle, and I go to the Puget Sound Venture Club and the Alliance of Angels, and I try to listen to smart people in town, and they tell me that the valuations you hear about in Silicon Valley, that the $8 million pre-money for the seed company, just doesn't. It's not realistic. It doesn't exist. It's not Seattle. In Seattle, it's like $3 million. I've been told it's about the range for a company of yours. New company, smart guys, great marketplace, but we're dropping $1 million in here. We think about 25% ownership would be about right. That's just what we're thinking. I
think those are all fair arguments, but you also have to look at the team. This team has a great track record of delivering successes, and given we have shooting on a great team, great idea, the market is right, timing is right. I think with $3 million, we'll be selling ourselves short, and I don't think it's.
Would you move a little on the 8?
Yeah, I'm flexible. We're flexible, but I'm here speaking for the team. But $3 million is just like a non-starter.
All right, would you do 5? Could we sell on 5?
All right, let's do 5.
Everyone think that's fair?
All right. So the next thing on my term sheet, and by the way, I had a great lawyer draft it. It's only 1 page long. So, some of these law firms in town draft these 8-page things. This is one page. It's a great deal. So in any event, the next thing I want to talk about is liquidation preference. And so here's what I'm thinking. We're putting hard money in. We totally appreciate the fact that you're humping it. You're down there in the dirt, digging and building this great thing. But we want a liquidation preference. We think that's fair, given that we're putting the hard money in. we're also thinking it'd be fair if we get a multiple liquidation preference and a participation right, which means we will get our money back, plus a multiple of our money, plus participate on it as if we were common stock as well after we get our money back. So, again, we're average guys. We're just sitting around town talking to people, and the folks at Alliance of Angels tell us that's the way we should go.
How many times the liquidation preference
we're
talking
thinking
about?
3x.
I think you guys are very well known in the town. You guys have deep pockets, but I think this is not just about your return. This is about a great idea we have on our team, and we're going to put our blood, sweat, and tears into it, and just putting 3x dilution, 3x liquidity preference, along with preferred participating. I think just the team is not going to end up with anything if it's not a huge exit. Obviously, we're in this together. We're going to try to capitalize on the opportunity, but I think we'll be setting ourselves for the failure from the beginning. And I would suggest that we'll have 1x liquidation preference, and that we are in this for the long haul.
Right.
So.
Well, would you consider? Let me just ask this question: would you consider a participation preferred if it was capped at some level, so we could economically model it out and cap it? Is that reasonable, perhaps?
I think it may be reasonable from your side, but you have to think this. We're taking the long haul. This is a seed round, and as time evolves, if we're going to capitalize on the opportunity, we're going to attract later investors in later stages, ABC, and I think we'll be setting ourselves for a bad precedent here with that much liquidity preference and having participating preferred. I think what seems reasonable at this stage is 1x non-participating. Is that acceptable to you?
Well, now that you mentioned subsequent investors wanting these terms that would be probably superior to what I have, I think maybe we'd rather not do that. So yeah, why don't we just settle on 1x non-participating right now?
All right, great. Well, thanks.
All right.
The next thing we want to make sure of, look, your company, we're totally excited and fired up to work with you. We're throwing a dart, in terms of valuation. We literally put a dartboard up there. But here's what I think. We settled that issue. But instead of just to calm the nerves just to calm my nerves, if by chance you sell shares in the future at a lower price per share, and I don't think that's going to happen, but if you do, I think it's a fair thing that you give me that sort of that adjustment in the price I paid. Because, it's a little vague right now. So here's what I propose. If you sell shares in the future at a lower price per share than what you sold me shares, I'll just get an automatic, what's called a full ratchet adjustment to that price per share. And it sounds bad because the word ratchet, it's got kind of a bad sound to it. But, it's not bad. Really think about it. I mean, all I'm saying is if by chance the next
not bad for the investors.
Well, what do you think? Can you help me out?
Well, I mean, I see your side that you have you fund this from all those limited partners and you have obligations to return your money, but you also have to note that you guys have a lot better insurance policies for your money than we do. We're in the trenches. We are putting our blood, sweat, and tears into this, and you have to also think that if we keep giving this ratchet thing to all the investors, this is just a seed round. The obligation of funding the company in later stage will be on you because every new investor is going to look at it and frown upon it. And so we don't want to set this precedent. You might have to give it up at a later stage. You might just as well give it up now.
Well, let me just try one more idea on you, just for fun. What about if we set the ratchet to expire? I mean, so we granted we don't want to go into perpetuity with some contractual term. That's ridiculous. But what if we just say, hey, for 2 years, we'll just do it for 2 years, and then it will evaporate, poof. But can we do something like that, or are you really just saying no?
I think that's a lot of pressure on the company. But how about like a broad-based weighted average anti-dilution that will give you a fair deal to you as well as would be attractive to future investors? Does that sound something reasonable?
Okay. All right. Let's just go with that and move on.
By the way, we're going to distribute the consensus term sheet after this, and if you have questions about it, Joe's your man.
Well, so the next thing I want to talk to you about is this concept. If say 3 or 4 or 5 years from now, you're
you've had success, you've achieved success with your company, but we haven't been able to position it so it's likely to be acquired by somebody. In that circumstance, I'm going to be stuck. There may be no secondary market for the shares, and I might just be sitting there with no opportunity to get out. What I'd like to do is I'd like to have the ability at that time to put my shares back to the company and force the company to redeem my shares. How do you feel about that?
So you're just in this for the money, right? Just for the money? You're looking at like if 4 or 5 years down the line we don't have an exit, then we're like a walking dead company. That's not what we're hoping for here.
Okay.
All of us are here. You're believing in us and putting your money into us, thinking that we're going to capitalize on this opportunity, and that's a dream. And we're going to realize that we have a great team working on it. But just having redemption rights right at the seed round, we're setting a bad precedent for future investment. And if you look at all the fair market deals that are happening right now, there is no redemption rights. So why don't we just take it off?
All right, then. Well, let's move on. So here's something I think maybe this would be more reasonable, and you would approve. The idea is, hey, look, if in a future financing, since we don't have any price protection, and you weren't able to give me any kind of multiple on my liquidation preference, we'd like the right to approve those events. So future financing is the right to approve it, and the right to say no if you want to sell the company for a price that's not going to satisfy our return. We'd like the ability to veto that. These are known typically as protective provisions. We'd like something along those lines.
So if I'm reading this right, you want to take the company hostage. That's what's happening here. You have to note that you guys have deep pockets. You guys have made money from a lot of exits, but having some sort of liquidity event would be a meaningful event for the people who are in trenches and the employees of the company, like founders and employees of the company. So I don't think it just doesn't feel right from the beginning. And like Len Jordan was talking, it's all about the trust. I'm not really getting a fuzzy feeling here with this term. And this is not like an 8-hour day job. It's like 14-hour day job for God knows how long. I'm opposed to having you guys or any of the investors taking the company hostage, but I'm not opposed to having some sort of like agreement upon we can't sell the company below a certain sale price. Is that something your firm would be flexible?
Okay, well, let's think about this for a minute. So yeah, first, yeah, I think we could agree on something like that. So we agree we can't veto a sale unless it's below a certain dollar.
Yeah, that's fine.
Okay, what about the future financings though? How about instead of giving us the veto right on that, you just give us the right to participate in that, whatever those terms are?
I think that's fair to ask for. You guys will have the first right to invest in the future round, and right of first refusal as well. So,
okay.
As long as we agree on the valuation of the company at that point.
Okay. All right. Well, let's talk about let's talk about something that's pretty important here, which is the board. So what we're thinking is, you and your team, you're plugging away, you're managing the company, the day-to-day affairs of the company. We think the right sort of blend for governance purposes is that the investors will have the right to appoint 2 of the directors, and that you and your team would have the right to appoint 1. So that'll give us a nice sort of balance. Since you're managing the day-to-day affairs of the company, then we would have the right to approve things that would be of interest to you, but give that balance.
Right. So 2 from you guys, 1 from us.
Right.
And we've seen a lot of cases where venture capitalists come in and then fire the CEO or whatever and take the control of the company, and eventually the company does not go in the direction that the original people had vision for. But with all due respect, we like your firm. I think venture capital is changing these days. Not just about the money; it's about smart money. And frankly, I don't think, with all due respect, your firm will have the time and energy. And I don't think you want to be in trenches with us. So I think. At this stage, it would be fair to state that we won't want to give a board seat, but having an observer seat would just be fine. So
no board seats, but you want to allow us to come to the board meetings?
As an observer, yes, that's fine.
Okay. Well, just think on this. What would happen if there was some sort of transaction between you and the company, or one of you and the company, that that needed the independent approval, how would you handle that? Would you come to us to talk about that?
I mean, yeah, you guys are like I just mentioned, we're looking for smart money, and we're here today because we like you guys. We heard good things about you and the value you can add. So obviously, we'll be engaging in conversations with you, and we need advice. And you will also be the first ones to hear directly from us if there is bad news. If you screwed up, you'll be the first ones to hear. So yes, we will be engaging in conversation with you. But so having an observer seat on the board would just fine. Will work for us right now.
All right. Well, let's move on from that for a minute and talk about financial information.
Notice how Joe never agrees to anything. he just says, "Let's move on to the next topic." So keep an eye on it.
Let me just say, I think we're okay with an observer seat.
Okay.
If you're gonna try to pin me down, if you really want to pin me down, I've got my wallet on the table here. I'm gonna put money into your company. I'm excited about it. No, but if we're not gonna be on the board, how do we know what's going on? I mean, what if you don't have any board meetings? What are you gonna do for me there?
We'll be sending you quarterly newsletters, and we're happy to send you quarterly newsletters. We're happy to let you know off the rec, if there is bad news, like we said. Like I just said, you'll be the first ones to hear from us directly, and we're not going to hide stuff. That's why we're not here. It's all about trust, but no audits at this stage, because the audits will be very distracting and expensive. But we can revisit the topic of audits at a later stage when the company has like $10 million in revenue. But yeah.
So can you assure me that quarterly we'll get financial statements?
Quarterly newsletters.
Newsletter.
Right. I mean, look, you're investing like $1 million, and this is a seed round. We just need money to take this company to the next level, and given the track record team has, I think, and the market and timing, I think we just need to be heads down and take this company to the next step. I mean, having all the distractions is going to hurt our dream and hurt your investments long term.
Okay, let me ask you this: could I have the right to come in and inspect the books and records?
I think just be too distracting. I mean, you just call me if you want to know about anything, and I'll tell you. Could I specify on a schedule? Let me just ask you this: Could I specify on a schedule how you're going to spend the money? The $1 million I'm going to write to you. I think we're just getting too complex, and I think I don't want to put in the legal documents, but I'm happy to update like in quarterly newsletter. You're one of the investors. There are like 10 other investors. If I keep committing this to everyone, I mean, look at the time and investment I'm putting in the company versus all these other things that are not going to matter.
Right.
So, I mean, are you with us for the long haul or not? I mean, that's the real question here. I mean, we're debating on all these terms that none of them is going to matter to help us realize our investment.
Okay, well, let's go to something I think is far more reasonable. Okay.
But do we agree on that no audits and quarterly newsletter is just fine for now?
What we'll agree to is this. We'll want an audit once the company reaches a certain size threshold. Okay?
Yeah, that's fine. That's fair.
Okay. And I think it's fair. You ought to allow us, and we don't have to be unreasonable about it, but we ought to get some sort of financial reporting. It doesn't have to be complex audited financial statements quarterly. We wouldn't want audited financial statements. We can't audit quarterly. No one does that. But we'd like something quarterly. Hit the print key on the Quicken and just give us the income statement balance sheet.
How about this? Let's leave this an open issue for now. I'm going to talk to some other entrepreneurs who have worked with you and come back to you on that one.
Okay. Yeah. Okay. All right then.
All right.
And if you need help, by the way, I've got some great CFOs I can recommend to you. If you need financial,
I think we're good right now on that.
Okay.
Thank you.
All right. So here's the deal. I think, look, if the company is in a position to accept a sale, and at least some of the folks involved want to accept the sale. So say, for example, your co-founder, say he wants to sell the company, and we want to sell the company. We want to make sure that no one else can cause the deal not to happen. So we want everyone to agree that they'll agree to go along to a deal if a majority of the stockholders agree. It's called the drag along. Again, it sounds bad. It sounds like a ratchet. It sounds bad. It sounds like something you don't want to happen to yourself. You get ratcheted and then you drug along somewhere. It sounds terrible, but it's really not that bad of a deal. And it actually helps you, because if you wanted to sell the company and we wanted to sell the company, we had an offer we wanted to accept, but your co-founder wanted to hold on, indefinitely, I mean, you'd want to drag him along. So that's what we're thinking. We're thinking a drag along. What do you think about that?
So basically what you're saying is like 80% stockholders want to sell the company, then the other 20% will be forced to sell their shares, right?
Yeah, we want to cut the percentage at like majority, not 80%, majority.
Right. So
Or maybe even just say me. Maybe even I decide.
With no offense, with all due respect to the venture capital community, as well as lawyers, as well as entrepreneurs in the entrepreneurial community, I think these terms are just too investor friendly. And I have to say that let's take a step back here, and this may sound good for you or me, but may not be good for as a team. Like united we stand, divided we fall. The sum of all of us together is greater than equal, like individual parts. So this just doesn't inspire confidence and just sets a bad precedent for the team and the morale. We just cut this thing.
So you don't want this thing.
This is just not good for the team spirit and the culture we want to set in the company. And you know what? Remember that the likelihood of us having a big exit is higher if all of us are together. If there are disputes, we'll resolve them. But I don't want to set this thing right at the beginning of the company.
Okay. I think I'm willing to move away from this thing. But let's talk about the shares held by you and your co-founders, okay? So here's what I'm concerned about. You're all working hard right now.
Right.
And we love you guys. However, and you're all.
You love the money.
Well, we're all hoping to make money. I hope you make money. I hope I make money.
Sounds fair.
It's a good thing all the way around. But here's the deal. Right now, you and your co-founders have all set up your share ownership so that you all own your shares outright. They're fully vested. But I'm concerned. I've seen it in other companies, and it doesn't have anything to do with anyone being a bad person. But one of the co-founders gets distracted. Maybe he or she has a child who gets sick and can't work anymore. And then you've got somebody who leaves the team, and you're going to have to replace that person. And they keep their equity even though they're not still in the boat rowing it. Or they, suppose maybe they meet the woman of their dreams and they move to Australia and they just won't answer email anymore. I mean, that happens. These aren't. We're not saying anyone's going to be a bad person, just quit and not work. I'm just saying if something happens that maybe is very good for that person's not working anymore, we want to recapture their shares. What's called vesting. We want to impose a vesting on your shares, and we want the typical sort of thing I've been told by my friends in the community is a 4-year vesting schedule with a 1-year cliff. So if you just flake out and quit working, or something, we can get your shares back. What do you think about that?
I'm thinking about it right now. Yeah, I mean, life happens, right? Like you mentioned,
and this is not just for me. I mean, this could be for you too. If one of your co-founders gets, if something happens, it might be something great for them. Again, maybe they meet the love of their life and they leave, and then they're gone, and then, you're sitting there thinking, gosh, co-founders in Switzerland won't answer emails, phone calls won't work. He owns 20% of the company. It seems unfair. That seems unfair, right?
Yeah, I mean, that's fair. I mean, these things happen. Life happens. People are in situations. But you also have to remember that we're taking a lot less salary than the market as the employees of this company. And we should have some sort of contingencies without any restrictions to just manage our lives. Like, all those points you're saying make sense, and therefore we should have some sort of provision that we should not have any restrictions on the transfer of some of the stock. And as for the vesting, I think a lot of us have been putting a lot of years of work into this, and we have assigned all the IP to the company. So we should, when the deal closes, we should be in the same boat. Our shares should be vested as well.
Well, okay. Let's just hit the pause button here. So I think what I heard you say was that you're generally amenable to something along these lines, some kind of vesting, but you maybe want to start the vesting period back when you all started working full time on this endeavor. Mm-hmm. So maybe we'll call it a 4-year vesting with a 1-year cliff, but we'll start that clock back when you all went full time on this deal.
I think that's fair, but I think that's fair to state that our vesting starts not right now when the funding is coming in, but when we started working on the company. That's fair, but Also make sure that we agree on the trigger. I would like to have a single trigger instead of a double trigger. And single trigger just means that in case of any acquisition or exit, our unvested stock is accelerated, as opposed to double trigger where the stock is going to accelerate if two events take place, one of which is like an exit or acquisition or IPO, and the second one if the company taking over fires some of the employees or the founders, CEOs. So how about single trigger and starting the vesting schedule at the time we started working on this idea?
Okay, all right. I think we can go along with that. I think there's some finer points in here you'll want to think on, but I think the last point we're going to talk about today is again this idea that if you have the opportunity to sell some of your shares that are vested or that vest somewhere along the way, we want to have the right to buy those first before you sell them to somebody else we don't know. Or alternatively, if by chance one of you finds a buyer for your shares that is willing to offer a whole lot of money, say someone offers you $50 million for your shares, we'd like the right to sell our shares alongside you in that sale, so we don't get left behind.
You're not going to get left behind, but we're not talking about apples to apples here. You guys have a lot more money from you're a venture capital firm, a deep fund, and you have realized these exits. People in the company are the ones that deep in trenches taking less salary and burning midnight oil. I think there should not be the same treatment. I mean, all you're doing, we really like you guys. We're here together. You're going to help us build this next thing and realize your gains along the way so you can return money to your limited partners as well as have your carried interest and build a great portfolio of working with us and vice versa. And we'll refer you great deals. So this is just not this thing you have to look farther than today. It's like an Amazon thing. You think about long term. And so I think the founders of the company and employees should not have any restrictions. We should not be just talking to you legally. We should not have any obligations or restrictions to transfer, sell our stocks, because we're just not in the same boat. However, we also have to remember it's all about relationships and trust. And if we hope that this is just the start of a great friendship and relationship, and you will obviously know from us that when an event like that is going to take place, or a liquidity event or secondary sale is going to take place.
Well, okay. So hold on. I think I'm hearing what you're saying. How about we do this? How about we allow some exceptions to the general rule? So the general rule is going to be, hey, we'll have the chance to buy your shares first, generally. However, we understand if you want to do some perhaps sell a portion of your shares, maybe 10 or 15% that are outside of our right of first refusal, we'll allow that. And then also, of course, we'll allow estate planning transfers or anything like this, trust for the benefit of your kids or something. So we'll make some carve-outs, but we'll still have this sort of general framework in place.
Yeah, I think. Look, I want to work with you on this, and we want to in this for the long haul, and we want to create a win-win situation. So yeah, I think the middle of the road approach that you just suggested, I think that's fair. What percent that is, I'm going to have to come back on that because I need to talk to some other entrepreneurs.
Okay. So. All right then. Okay. So I think this has been a helpful meeting. What I'll do is I'll work around that term sheet I gave you to make it fit more what we just discussed. And I'll send it back to you. And then there's a few other items that we don't need to waste time talking about right now, but you can read them. And if you find them offensive, you can call me and tell me so. There's just some small things in there, fine print. Just not things that were very significant.
Yeah, so here's my request. All the changes that you make, please redline them.
Okay.
And obviously we want to close this deal ASAP, but please note that we're not going to agree or sign these things without doing proper diligence on both sides, hopefully. And yeah, and this has been very helpful, and thank you for your time.
Okay.